This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network and Maj Soueidan are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy, sell, short, cover securities in any company mentioned and may profit in the event those securities rise in value if we are long and fall if we are short. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome back, everybody, to the Avoiding the Crowd podcast with your host, Maj Soueidan. I'm the producer. That's it. I just produce. My name is Robert Kraft. You can follow me on Twitter at Bobby K. Kraft, BOBBYKKRAFT. And welcome to this episode. We have a guest today, and we're going to get right into it. So first things first, Maj, how are we holding up?
I'm doing great, man.
Are you in a bunker somewhere?
I'm in one of those phone booths, a shared office space. Because I'm doing a little traveling, so we thought about doing this podcast on the go. So I wanted to do it, so I found a nice quiet spot for us here.
Nice, look at that. It's nice. The sound is nice and everything. I like phone booths. We're gonna have to figure out a way to do phone booths from now on. I like this. And I'd also like to welcome our guest today. How rude of me to not do it at the top, but I'm gonna do it now. We got Brandon Beylo, the host of Value Hive, the Value Hive podcast, right?
Yep.
Yeah.
Correct.
Okay.
Yeah.
There it is. I should know this. I was a guest. I mean, come on. Actually, Maj was a guest too.
Yeah, so, you both are. You both are nice alumni of the show.
Yeah, I'm an alumni. You hear that, Maj? We're alumni. That's fucking awesome. Oh shoot, I cursed, but I'll be. That's awesome. Well, Brandon, it's awesome to have you on. Well, first, how you doing, man? What's going on?
I'm doing well. I'm also in a shared office space. It's not as intense looking as where Maj is. It's a little more bright. I got sun coming in the room, but I'm doing well. Staying busy.
Look, this is a big deal. Okay, Brandon finally agreed to be on camera for an interview. All right, I tried to do this when he interviewed me. I'm like, dude, come on, we gotta record face to face. That's how we do things. And we did, but so this is if you didn't know what he looked like, this is him. This is Brandon right there.
This is me in the flesh.
This is for those listening. You're gonna have to watch it on YouTube. But anyways, the main. So cut to the chase. What we're talking about today is, Maj wanted to have Brandon on, and of course I wanted to have him on too. Is he was inspired by a tweet that he put out recently regarding value traps. So, I mean, I think we could go on for hours on this topic, maybe days, but we're gonna try and condense it into a nice episode here. So. I'm gonna hide my screen and let the two gents duel it out here. So Maj, Brandon, take it away, guys.
Thanks, Bobby.
Thanks, Hey, Brandon.
Hey, how you doing?
Good to be on this side now. Pressing all on you finally. See how you like it.
I know I'm a little nervous. Not gonna lie to you.
So why don't you go? So before we get into value traps and the tweet that kind of attracted my attention, instead of me talking about you, why don't you talk about yourself? You have a website, you have a podcast. Give us a little background and maybe a little background on your investment style too.
Yeah, sure thing. So, first time being a guest on a podcast, I haven't really, refined my pitch to myself. But what I would say is I'm the lead value investor and classical chartist over at MicroCap.com. And I started a blog called The Market Plunger a few years ago. And I would just pen my investment thoughts down, would take ran a paper portfolio, did kind of like a faux hedge fund thing and just started scribbling down some ideas, got a Twitter account, started posting some stuff there. And now most of my research is done for MicroCap. Alex Barrow, he's the founder over there, and him and I tag team the research and we try to find asymmetric investment opportunities anywhere in the world, any market cap. So been doing that since September of 2019 and wanted to start a podcast. It's been almost a year now since I started the podcast, and it was just trying to scratch my own itch about wanting to learn from those that I thought were, way better at me in this game, which is a pretty easy hurdle to jump for a lot of these guests. So just learning and growing, trying to find companies, trying to understand businesses. And when I look back, even from when I started 2 years ago. It's just amazing, the progress in the sense of, how I think about business, how I think about valuation. And it's going to get into our topic of value traps, but even, thinking about how I even start looking at a company and what I want to invest in and what types of businesses I want to invest in. So as a general, investment philosophy, I like to invest in businesses where I think they can generate a lot of cash over the next 3 to 5 years, and they can reinvest that cash back into the business at high rates of return. We can talk about this later, but I try to avoid commodity type businesses because we'll have some examples there, and I try to focus on things that I can easily understand, which really narrows my universe. But at the same time, really focusing on expanding that circle of competence and letting my natural inclinations and natural thirst for knowledge drive me towards different industries where I want to learn over time. So that's kind of the investment thesis in a nutshell there. I do look at microcaps, and actually we're going to talk about a stock at the end that is a microcap. That's my biggest holding. And so, I'll kind of let you take it away from there.
You weren't kidding when you said that you'll invest anywhere and any size. I mean, I remember when you first did a pitch on littlegrapevine.com, you were one of the pitches there. This Polish company out of nowhere, and I love that about you. That you're willing to look outside just the large caps and look for some really hidden gems in other areas, countries, market cap sizes. So, and I really we've had some conversations about smaller companies that I've owned and we actually both owned. So I appreciate that you're willing to do that, and just was really like the way you think. And then, so really today though, the subject is value traps, and, basically it's, if it's too good to be true, sometimes it is too true to be true. Right.
Yeah.
But I came across one of your tweets here. I'll just read it. And sometimes it's hard to avoid value traps. The stock looks so cheap and we feel so lucky to find it. And I wouldn't mean you, Brandon. I wrote some thoughts on using Occam's razor to help distinguish a genuine turnaround from a value trap. And you have a little image there, and you talk about good reasons and bad reasons. So why don't you go through, what made you think about this thing? Did you just come across it, or was it a thought you had, or were you thinking about it for a while? And you list the good reasons and bad reasons, and really want to go over that. Maybe you just enumerate them, and then we'll get into it a little bit. Yeah,
sure. Let me pull up the article real quick. But basically, it came up. Sometimes I'm just sitting there thinking about, how can I get better and how can I reduce the errors? Because a lot of investing for me isn't necessarily about finding, the next big winner. It's about making sure how can I not screw up, right? It's about, Charlie Munger's, tell me where I'm going to die so that I don't go there. And so one of the things is like, okay, how can I find out where I can die and let me make sure that I don't go there? And so the way I'm thinking about that is through the lens of Occam's razor. And basically, this idea of Occam's razor is if you have a lot of moving parts, like let's say you have this bullish investment thesis and it requires 6 to 7, maybe even 10 things that have to go right in order for you to make money or in order for the stock to, hit your price target over the next 3 to 5 years. If you've got that idea, 6 to 10 things that have to go right versus an idea where you only need a couple things to go right or 2 or 3 main drivers to go right, then according to Occam's razor, you should actually take the idea with the fewer steps in it to get to the end result. And the reason being is it's just creating more robustness within your strategy and then even within the individual company. So, we can kind of dive into one of my worst ideas that I like to talk about a bunch is it was called Target Hospitality, TH. I don't own it anymore. And basically the thesis was, okay, look, you've got this business. It's a SPAC, and this was SPACs before they were really cool. So I timed that way wrong, but this was a SPAC in the oil and gas industry. It was hospitality. It was targeted to, the Delaware Basin. And basically what the business did is it provided short-term housing for oil and gas employees while they were out there working on the rigs. And so, thought it looked cheap, went through the business, did some analysis, but then I realized that the things that had to go right were things that were out of my control or things that were out of the business's control. For instance, commodity prices. So, as long as oil stayed at X, the business would do well. But if oil went underneath, a certain amount of, call it X, this price here, then no matter what the business did, it wasn't going to necessarily generate those cash flows. And so you had all these steps in this process. Well, okay, if oil's here, then the business can do this, and we need this amount of people at each basin, and we need the basins to stay occupied for X amount of time, and we need oil to stay at this price. That way people actually stay there and rent out these hospitality, these temporary housing. And so you had this big complex thing and a lot of moving parts, and it ended up being like a 6,000 word write-up that I did. It was one of my longest write-ups. And there's a inverse correlation between the amount of time that you spend writing about a company, doing a write-up, and the estimated results of that company. So for instance, SumZero did a review, and they basically said, the longer the write-up, the worse the stock did, and the shorter the write-up, the better the stock did. And so Occam's razor is really all about that. It's about finding these companies where they're quote unquote no-brainers, where you only need one or two things to go right, and the business is going to take off and the stock's going to follow.
Excellent. I love that. Now when you're doing that, are you so you looked at it from the what can go right perspective? How do you? Is there you got the what can go wrong perspective too? Is there a way to approach it from that perspective too? Does he talk about that? Okay. Yeah.
So the way I kind of look at it as what can go wrong with the stock, and just trying to figure out if it's a value trap or not, is taking the expectations investing approach, where it's okay, what's the current stock price, and what needs to happen over the next 5 years, 3 to 5 years, to actually reflect the current stock price. And so on the downside, it's thinking, okay, worst case scenario, or in a bear case scenario, what's this stock price going to be to my estimated value over the next 5 years? And for some of these things too, you also think for the ones that have the simple drivers on the upside, it's also going to be simple drivers on the downside, because you're going to say, okay, if this company does, one or two things right, then their stock price is going to take off, the business is going to perform. But inversely, if the business fails to do those two things, then you're also going to experience, that thesis isn't going to play out. And right. So that's kind of where you get into the pressure of value traps, in the sense of you can take a crappy business that has a lot of moving parts, and you can say, oh, well, if XYZ, if 1 through 5 goes right, this business is going to do well. But with those businesses, the reason why they're crappy is because all you need is one of those things to go bad, and then the whole thing falls apart. So what I would rather do is say, okay, look, my upside is triggered and catalyzed by one or two things, and then my downside is the inverse of that. So for instance, like an example, like Roku, I'm invested in Roku. It's a larger cap, name, but basically it's like, look, if they can grow their household users, and if they can grow the average revenue per household, get more eyeballs in front, then they can create more advertising dollars, which means more people want to be on the platform, which will make more users, and then you get that effect going. The same thing happens on the downside. If they don't grow their user base, if they don't grow their active users, then that thesis probably isn't going to play out. So that's kind of the way I look at it there, is like, I want to find the fewest drivers, even on the downside too, where it's like, okay, really one or two things aren't going to go right. Let me model that out over the next 5 years to see where the current stock price is. And even, I want to buy at a point where I'm not really getting I'm not paying for any of that growth over the next 5 years. So on the downside, it's like, okay, if this thing happens, is the stock price currently, is it roughly around that current price? Mm-hmm. And then that's kind of how I keep diving into that name.
Excellent. Funny thing is, over time, as I became investing, and it took me along my journey. I didn't analyze what I was doing. My taking postmortem of what I did for years after I invested, obviously, because you got to create history. And then, it took me many years to figure out, what, some of my best performing companies had one thing go right that really defined the company.
Yep.
And I struggled with a Geo. If I'm writing an article, I said, I only have 3 reasons why I like stock. I need to make this longer, right? Because, what are my members paying for? But sometimes the simple stories and the ones that have this one catalyzing part of the story are what I find really makes some of these things really interesting. We call it the big hairy ass fact, the Geo. Can I find that one really thing? And if I can't find it, I really don't love it. I might like the story for some other reason, but I don't love it for this, 5-year or 10-year holding maybe.
Yeah.
And it's kind of a similar kind of thinking here, I think, to some degree. One thing is, so I remember Peter, we have these GARPers, right? Growth Reasonable Price. And that's kind of where GARP kind of sits, because, some things, the GARPers don't buy things that are too cheap too, because they believe that it's too cheap for a reason maybe. when you have really, really low PEs and, really low book values, or multiples, there might be a reason for that. And, what I found is like, these value traps can occur along several different, parts of a story. For example, if you have a great catalyst, right? You think you have this great catalyst or two or three, but you got incredible customer concentration risk, it might not matter, right?
Right.
Because unless it's related to that somewhat. So, yeah. So, I mean, now in the tweet, you list some things, good reasons and bad reasons.
Yeah.
And why don't you go over those? Maybe the good reasons first.
Yeah, sure thing. So you're kind of referring to that little image that I had within that tweet. So it's basically one way to avoid value traps is just to ask your question, why is the stock being sold? And the person that really hammered this home to me is actually Brad Hathaway from Farview Capital. He was on my podcast a little bit ago, but it's really, really asking yourself, you are in a public market with millions of participants. Why are you the one, why are you privileged enough to find this company before anybody else? And, what sort of insight do you have that no one else can have? And so you just have to ask this question, why is the stock being sold? And there's good reasons and bad reasons. And so good reasons is, there's forced selling. Think of spinoffs, both on, a large company spinning off a smaller portion of their business, and the existing shareholders don't really want to buy, and it's not part of their core strategy. Or you have institutions that just can't hold that micro cap or small cap spinoff due to their investment mandate. Or you can also have institutions that sell because of, let's say, liquidity reasons, like you saw in March and April with the preferred stocks. I don't know if you tracked any of the preferred stocks, but I remember talking to Andrew Walker over at Rangeley Capital, and there was just some crazy prices on these preferreds because you had one big preferred stock, institution that had to sell for liquidity reasons. And so you've got that. And then you also have what I call good co, bad co dynamics. And the person that really hammered this home to me was Matt Sweeney over at Laughing Water Capital. And basically it's this idea that you have this business that has two operating segments. One of them is really good and one of them is really bad. So let's say the really good business, let's say they make toothpaste and they have high margins, high returns on capital. They're earning $2 per share. But then they also have a toothbrush business that sucks, that's losing $1 per share. And so collectively on a consolidated basis, you're going to see that this company's only earning $1. And if you dive deeper, you can say, oh, look, well, they've got this really good business that's earning $2 per share. They've got this crappy business that's losing $1 per share. If management decides to spin off or decides to divest from that crappy business overnight without anything going on in the market, you have a business that just went from $1 per share of earnings to $2 per share of earnings. So that's a good reason for a stock to be sold. A third reason is a one-time earning miss. So, around earnings season, you can get these big, crazy swings in stock prices from a company missing earnings, whether it's, a few cents or, even if it's a big miss. Sometimes you can get a stock that falls really fast and really far. And if you can say, hey, look, looking out 3 to 5 years, is this one earnings miss? Is the reason for this earnings miss affecting its long-term potential to generate cash flows? And if it's not, then that becomes an opportunity. And then that becomes a good reason for the stock to sell. And then another reason, kind of like what you mentioned earlier, like looking at the Polish markets and stuff, the underfished areas of the markets. So this is, Poland, Italy, Africa, the Middle East, like a lot of places where investors aren't searching for ideas. Sometimes stocks are being sold there simply because no one's buying them. There's really not a market for them, or they're thinly traded and you have an individual investor that holds a good amount. And for whatever reason, they have to sell. It could even be personal. So that's another reason there. And then the last reason, when I say last, I just mean last on this list. There's obviously more to this, but optically high debt burden. And when I say optically high, what I mean is there could be a company that's got, long-term debt on the balance sheet that looks big, but then when you dive into it, you see that it's, covenants are pretty relaxed in the sense of, if it generates, less EBITDA, let's say it's a cyclical business that has pretty relaxed covenants on its debt where, it doesn't have to hold a certain EBITDA to net debt margin, and it's really low interest. And they'll actually be able to pay that off fairly easily, then that's something that you can take advantage of too, because sometimes people screen just purely on a net debt basis. They don't want to see any debt. And so those can present opportunities. And then moving on to kind of the bad reasons, and you ask yourself, okay, why is a stock being sold?
Hey, can I slip in there for a second real quick?
Yeah, go ahead. I mean, I got to take a drink anyways.
I love this list. I mean, what I like about it, it's defining where a lot of multi-baggers are found, but it's also, there's some short-term opportunities in these things too you're talking about, and how you want to look at them. A lot of these things that you're talking about can have a temporary, decrease, lead to a temporary decrease in the stock price. And if you're even a shorter term investor that wants to invest on fundamentals and make money in the short term around your longer term portfolio, things that you talked are great stuff. But I'm wondering, when you're, you said that you invest in MicroCaps across the whole spectrum there. Do you find a good amount of these things in the larger cap stocks, or are you mainly finding these in the smaller capitalized companies?
So I mainly find these in the smaller cap, but I will say if you go out and you look ex-US, and if you look at these developing nations, particularly in Europe and stuff, I think Aaron Edelheit just wrote a post about how value is alive and well if you look outside the US, even in these larger cap names. So I think you can still find this stuff, but at the same time, I guess I would say more of these dynamics are leveraged to microcaps, where if there's forced selling, it's probably going to be exacerbated in the microcap space than in the larger cap space, or if there's a one-time earnings miss because of the liquidity effect, right? So you could have one major shareholder own a microcap stock, and if they have one earnings miss, for whatever reason, that major shareholder could just sell. Or if he, just has a big portion of his net worth in the company and the stock's done well, and he just decides to sell because he wants to buy another house or, send his kids to college or something, that could affect the stock price more than a larger cap name, again, due to liquidity. But at the same time, you have to think, especially in the spinoff area, international spinoffs is something that I want to get better at, because recently the US spinoff market hasn't really done well. In fact, it's kind of been trash over the last year and a half to 2 years. But one of these things is, you look at these international spinoffs, you have less competition looking at these names, but you still have the same dynamics of the forced sell-off. And so it's kind of an interesting area where you get the benefits of a spinoff in these international waters or these international companies without necessarily the fierce competition of everybody looking at these names right as they spin off.
Right. Yeah. And it's, and it's interesting too, one of the things I go through when I'm looking at these nano cap areas and microcap areas is you find some of these opportunities that you're talking about, and you start asking yourselves, "Oh, why hasn't anybody else found this?" And you get scared sometimes, right? You're like,
yep.
Because you don't know if it's because they're nano caps or because there's a reason for it. But something on the particular list that you mentioned here, one of the things I really liked that I started doing over the last several years was this forced selling by institutions. Looking for those opportunities, and a lot of times you'll find them in some nano cap names, but they're actually big cap companies in terms of their size. I can remember BLBD was I think one of the leading, or maybe the leading school bus manufacturer here in the U.S. And there's a BXC, which
that's what Blue Links,
which was a building products manufacturer, mainly wood products, so lumber. And I'd owned both of them, and and part of the big reason I had bought the stocks were because I knew these. The story at the time were pretty decent. BXC had a high debt burden situation, and that's why the stock was depressed, and people didn't believe in the turnaround story necessarily. And what helped them get through the recession in 2008 was an investment through Serbius Capital, and I think 51% of the company. And Serbius was, it was a friendly investor, but it was limiting what the company could do strategically. But we knew there was going to be a certain time where Serbius was going to have to exit. And they had made a offer for the company back in 2000, I think 8 or 9, which the company or maybe 10, which the company rejected at a much higher price than where the stock had been at recently. So we knew they couldn't come back with a going private offer, and the company was in a better position. This is about 2016 or so. So when I first bought the stock, I think it was around $8-9, and it went 10, 11, 12, a couple of years sitting there. Then it went all the way down to 7, because there was an offering going on. Serbius was getting out. The Serbius wanted to get out of stock. It was so illiquid that they just had to, they got out, they had to, $7 was the price. I think the stock had come down from 12 to 7. This is incredible. So, and then the stock was shot up like to 40, $50 or close to it, like in one day after making an acquisition. Basically, Servius sold the stock. That freed up management to go do their strategic type of plan. They bought up, and they made an acquisition, and the market got pretty optimistic about it. This integration problem, stock came all the way back down. But it was an interesting thing you're talking about. And the same thing kind of happened with Bluebird, where, the PE firm there wanted to, take the company private at what we thought was too low of a price, and we wrote about it as an activist article kind of thing. And the stock ended up, doing really, really well. They had warrants, and that was a situation where they eventually sold the stock, and the stock went up because they got out of it. And
well, I think just to kind of reiterate this point is you have to also keep in mind of why these institutions are selling. So the big idea is forced selling. It's not enough to see just an institution or a large shareholder sell, because sometimes they have more information than you. They might be closer to the situation. They might know a lot more than you. I know Mark Minervini likes to talk about this, where, institutions really do move markets. And he likes to say, if you've got big selling or big buying, it's not your Aunt Sally that's buying a few hundred shares here and there. Like there's a reason this is happening. Right. And you just have to figure out the reason. And so one of the things, I was researching a stock, Jumbo Interactive, on the ASX, JIN. I don't own it. I might, but I don't own it right now. It's an incredible business. It's actually a business that appeared in Connor Haley's mega list of multi-baggers that he released. And basically the stock sold off really hard. If you look at the chart, let me just look at it real quick. I got it right up here. So the stock sold off on September 21st, the week of September 21st, sold off 18%. And so you look at that and you say, wow, that's, what's going on there? So, immediately your mind perks up and you just kind of go there and you say, okay, someone's selling. And so on September 21st, there's an article that was released that Tabcorp Holdings sold an 11.6% stake in Jumbo Interactive. And so first off, you're thinking okay, what's going on? Why are they selling? Is it a fundamental reason that the business is deteriorating, that these guys are getting out? But it turned out that Tabcorp was just selling because it wanted to pay down some existing debt that it had on its debt facilities. And so with that knowledge, okay, the reason they're selling isn't because that there's something wrong with the business. It's because of this external factor that they had to deal with. Right. And that's when you get excited. It's sometimes selling, forced selling or heavy selling just for selling's sake is not the indicator that you should go in and buy, because I think that's where you also get involved in these value traps, where a lot of value investors say, oh, it's sold off, it's at its 52-week lows, I'm going to come in and I'm going to see, and I'm going to buy, or I'm going to buy this off the 52-week lows because, it's a contrarian pick.
Right.
But really it's not. If people are selling and there's a good reason to sell, then you're probably just adding liquidity to the short sellers' ability to take profits.
Right.
And so, I tweeted about this last week, I think. But it's something that I've just started to realize over and over again. It's I think the real contrarian play, and maybe a way to avoid these value traps, if you want to call them that, the way to avoid them is actually for value investors to screen 52-week highs and not 52-week lows, which is just totally contrary to kind of how we're taught and kind of what a lot of people think. But it's something that I'm meditating on and considering.
That's an awesome point, Brandon, because for the first, I would say 20 years of my career, that's what I did. I mean, I was about trying to, I would track the new high list at that time, 12-month, 52-week highs, and, look for good value in that area. And it's contradictory to what a lot of people believe. Of course you can find it there. And it's not the price of the stock, or the chart, it's the actual business that matters. And our job as investors is to find out, why is the stock hitting a high? Is it just pure speculation, or is there a reason? Because good things should go up, right?
Yeah, well, exactly. And it's almost like I mean, how do I say this? But it's almost as if the people like to say or like to point at a greater fool's theory for stocks that are going up, but yet they won't apply that same analogy to stocks that are going down. Because sometimes if you buy off the 52-week low list, you could just as easily be playing the greater fool's game. Just as if you buy stocks that have been going higher, and you buy them because you think they can keep going higher. Everybody at the end of the day, whether you're buying at the 52-week low or the 52-week high, you're buying because you think the stock's going to go higher. So why does it matter if it's at the 52-week high or the 52-week low?
Right. And it's about just analyzing the company, right? So what you're basically saying is, if you're at a high, why is the company at a high? Is it pure speculation, or is there actually really good stuff going on with the company? If a stock's near its low, why is that it's low? Is it a low because it deserves to be there, or are these non-fundamental factors that are causing it to be there? And that's an awesome way of looking at it. It wasn't until later I don't really do a new low list that much, but I do it with that mindset is, what can I find here that maybe people are wrong about why they're selling it, right?
Yeah.
And I might look at short stocks on the highs. Why are these stocks hitting highs? But it's just like I find more opportunity personally in the high list over. I found a lot of my multi-baggers, and it makes the process really like for beginner investors who are trying to find a process to reduce the investing universe to a meaningful level. A manageable level. Yeah. It's easy. Here's the high list. Go through my check boxes. It just makes the really process a lot easier, I think.
Yeah, well, I mean, if you listen to, I hope I don't butcher his last name, but I think it's Paul Andreola. Yeah. So, I listened to his podcast with Toby. It was one of the best podcasts that I've listened to all year. Because look at Bobby, he's throwing his hands up like, what the hell, man? But no, I mean, because he kind of had this mentality. He's like, look, he talked to a guy that made stupid money, and he said, what did you do? He said, I just bought all the stocks that were trading like at $1 that hit their 52-week highs. And it's just, it's this idea that, the other thing too is a lot of people start value investing looking at the 52-week lows, but those are places where you can actually find good shorts, is the 52-week low list. Mm-hmm. And, it's probably going to upset like a lot of like hardcore value investors, but I was talking to Value Stock Geek, who's one of the smartest value guys on Twitter. And we were just kind of going back and forth, and he knows that I do, a lot of charting in my analysis, long-term charting. And, we were just kind of going back and forth. And I said, look, if you just applied like a simple momentum factor, just a simple moving average factor, you could very well eliminate your odds of buying these value traps. Because the fact of the matter is, momentum does matter in the market, and you could be right about a name, but the market might not agree with you for, 3-5 years, like who knows how long. And so if you're looking at the lows, you're fighting against momentum. And even if you're right, you're still fighting against momentum. And so It's one of these things where, you would rather have momentum on your side than not have momentum on your side. Even if you're a value-based investor, like at the end of the day, you still need the price to go up. You still want that upward momentum. So even just, for beginner investors, just put that simple moving average filter on there, and you'd be amazed how many stocks you avoid that just keep falling by not buying stocks that are below a moving average and making new lows. Yeah, it's so counterintuitive, but it's something you should try.
Yeah, and I've held stocks hitting lows, and they keep hitting lows. When you're thinking, and they keep going lower, and it's definitely so true. I know that probably the first 20 years of my career, again, I was doing that, and I was probably 100% of my portfolio return those kind of returns, every year for most of those years, and it was all because of what you're talking about. And I saw no reason to go outside that. To tell you the truth, when I tried to go outside that momentum approach, my returns got a little worse. I tried to say, all right, well, what am I missing here? I want to get these a little earlier. And you can, of course. But I just figured that there's really power of momentum. And the issue sometimes with these, stocks that aren't in momentum phase is that even if they're doing fundamentally well, but the market's not finding them, by the time 2, 3 years, 4 years passes me, they're not doing so well anymore, right?
Right.
And then the stocks, they never made the move. So I think a nice blend of everything is pretty important. But I'm glad you brought that up. And one last thing on the for selling thing is, so when you looked at, because when we're doing this podcast, Brain would like to teach too, and trying and get specific as we can sometimes.
Right.
And when you talk about the for selling thing, so in the Serbius case, or I'm going to, with the Bluebird and the Blue Links, a lot of these private equity firms have a time limit where they have to sell the stock. They can't hold it forever. Mm-hmm. And I think that's one of the things you're talking about. So, trying to look at these stocks that maybe have had private equity ownership for a long time. Yeah. And it's getting close to, hey, our charter says we got to sell this thing at some point, is an interesting kind of thing there. We also like secondary offerings where there's a big seller getting out. We talked about
Mhm.
earlier, just wants to get out for some reason. But,
Yeah. Well, here's just to kind of go off of that private equity idea. There was a company that I invested in a couple years ago called Construction Partners Road, ROAD. I don't own it now, but it was exactly like you said, Maj, where it was formerly private company involved in a PE business, and the PE company, private equity, they took it public, and they were getting paid. So they were cashing out, right? It makes sense. Like, they took it public, they don't want it on their books anymore. They bought it, they, brought it to the market, made a handsome penny. So you had that private equity firm just selling at the market as soon as this thing IPO'd, which makes sense. You can't blame them. But what's interesting is, while they were selling, you had these directors of the private equity firm that actually bought personally. And so while the private equity firm itself was reducing its stake to free up capital, maybe to buy another business to try to do the same thing, you had the actual directors and the owners of these PE companies buying the stock personally, joining the board, and having skin in the game. And it was, it ended up being a really great, it ended up being a really great deal. The stock sold off in December of 2018, all the way down to like $8 before making, highs a year later up to $20. So it rose basically 140%. But it goes back to what you said. Like, why did this stock sell? Right. It didn't sell because its business was deteriorating. It sold because of these external factors. A PE company wanted to have a huge profit for their LPs, obviously.
Right.
And so you understand that. And then what you do is you track it and you watch. And so, this thing was this thing was hitting new lows. And then it put in a base between October of 2018 and December of 2018. And then you started to see the buying come back. And then that's when I was lucky enough to get in and, wrote it up. But it just goes to show, finding areas where people are selling for reasons that aren't related to the business.
Mm-hmm. Love it, man. Love it. So let's go over to the other side of that now, your Twitter. And you talk about the bad, right? The bad reasons for why a stock might be being sold, right? Or actually so why don't you talk about that a little bit and go through those bullet points?
Yeah, so we'll kind of go through these one by one. So the first one I'm reading off it is poor acquisition. Second one, slip debt covenants. Third one is rising SG&A costs. Fourth one is shrinking margins. Fifth one is heavy insider selling. The sixth one is asset play falls through. And then I made a seventh one, a little lighthearted one, a Hindenburg short report. Those are all bad reasons. But the first one, poor acquisition. The data shows that it's really hard to create shareholder value when you do these big acquisition deals, unless that's part of your strategy, right? Unless your strategy is to go out and expand and acquire these businesses. But if it's not core to what the business does, or if it's this random acquisition where they were growing organically for a long time, and then all of a sudden now they have to start buying these companies to grow inorganically. That's a cause maybe not to rush in and buy, but just to say, okay, well, why did they switch from organic growth to inorganic growth? This is not part of their core strategy. It never was, something that they said that they were going to do originally. And then slipping debt covenants is obviously not a good one. I learned this the hard way. I was invested in Garrett Motors, GTX. And I have to give a shout out to Alex Jones, not that Alex Jones, but my buddy Alex Jones, who came on my podcast, and he's an excellent analyst. And I was buying Garrett, and it was after the spinoff, right? It was actually one of those where it was like, hey, look, this is forced selling from institutions. Honeywell share owners didn't want this, small turbocharger business. So I scooped in. I said, oh, let me look at this business. This is interesting. It had optically high debt, or so I thought. It had these asbestos liabilities that looked huge on their balance sheet, but it was actually pretty manageable when you looked at the annual payments they had to make. And so I was just going back and forth with Alex over dinner, and he just stops at one point. He goes, I think Garrett's a zero. And so it was actually, one of the first holdings where I was saying, like, hey, what do you think? What do you think? And it was kind of the first time where someone was like, I think this thing's a zero, which is funny because, you get into this broader philosophical idea of trying to reduce your own confirmation bias, but I just couldn't wrap my head around the fact that this thing's going to be a zero. But lo and behold, Garrett slipped some debt covenants, and it is now trading GTXMQ.
The Q.
So, yep. So I was lucky enough to get out of that thing before it all went down. But it's just another personal example of slipping debt covenants and just kind of paying attention to that, because the stock was being sold, and here I am thinking like, okay, well, it's got all these good reasons, it's got all these interesting, attractive qualities to it, but you gotta play that devil's advocate with yourself. So there was that one, and then rising SG&A costs. This one you don't necessarily want to see over time, especially if the business isn't growing revenue. So if you see rising SG&A costs, you got to ask yourself, why are management paying themselves higher salaries even though they're not delivering on revenue growth? Are they spending money on stupid things that don't actually improve the fundamentals of the business? So obviously you're going to have maybe some SG&A costs rising over time as the business grows, but you want to see that in lockstep with the actual performance on the top line of the business. So if you see revenue growth start to decline, but yet SG&A costs are exploding, dig into the financials, see what that is. Is management paying themselves too much? Are they doing not ideal things with their cash on that end? Mm-hmm. And then that goes right into shrinking margins. You really want to get to the fundamental unit economics of a business, and the best way to find that is looking at gross margins and operating margins, and gross margins in particular, because operating margins can be marred by short-term issues. Like if a business is reinvesting a lot of their money back into the business, they might have operating losses. But really looking at the gross margins, like, does this business actually make money? Does this business actually produce a decent gross margin? And you will avoid a lot of value traps by just not investing in companies that have shrinking margins. Mm-hmm. But again, you always have to play the caveat. Like, look at the general industry. Is this an industry where it's actually a low margin business, and that low margin is a competitive advantage? So think of capital intensive businesses, things like that, where a low margin keeps competition at bay. There's not people coming in trying to take your margin because you're making 5-6% gross margin, 1-2% operating margin. So keep that in mind when looking at things. Does the gross margin match what you would expect for that industry, and is that gross margin growing or shrinking over time? Mm-hmm. And then heavy insider selling. So this is one that I'm just
tough one though, right? Because
it's so tough. And I put that on there, and a part of me was like, well, that's not like, it's bad. Yes. But there's so many reasons why someone could be selling a stock. Like I said,
as Peter Lynch says, he's like, there's one reason they buy and many reasons they sell, right?
Yeah, exactly. So for instance, like there is a holding that we have at MicroCap. It's Cardlytics, CDLX. And we've just watched this stock get sold by the insiders for months. It's had heavy insider selling, and we just never understood why. And this is the one reason that I have the most trouble codifying, if that makes sense. Mm-hmm. So the other things you can justify, like, this business had 30% margins, it shrunk down to 10% margins. I don't really want to be in that type of business. But do I want to, it's harder to make that decision when I have a business that meets all of that criteria, and yet I see insiders selling. And so, I wish I could tell you, Maj, that I've got this like great bulletproof strategy for deciphering what is good selling versus bad selling, but I don't. And I don't know if I ever will. And so it's one of those things where you just try to find out as best you can, talk to people, see if anybody has an idea why they're selling. Try to reach out to management, be like, hey, what are you trying to do? And they might not even be able to tell you, like what are they going to say? Like, oh yeah, I'm selling because we're about to post negative 50% year-over-year growth. Like, oh, okay, well, you can't tell me that. so that's the one reason where I just really struggle. And if anybody's listening to this that has any better ideas, which, it's probably easy to have a better idea than what I just threw up there.
It's tough, man. You're right. That part of it, I struggled with it for a long time, and I get mad a lot of times. I see insiders selling my stock, but then I calm down a little bit. And well, especially in the smaller company space, because these CEOs are young. Well, they're not. They're still been growing the company, putting their heart. They're sweating to it, the blood, tears, and there's the opportunity to take some money to do it. Maybe they might be building a house. Kids going to college. All these little small. I know there were a couple of stocks. I had the daughter just wanted to sell some stock.
I know, and it's so funny.
And it was like, all right, well, I guess, and then turned out being right, and it wasn't nothing to be worried about. But it's the hardest thing I've had to deal with is like when is insider selling a red flag, and sometimes you can look at past kind of like performance of the stock depending on which insider selling, if there's a pattern there. But yeah, I'm with you on that one. It's tough, man.
Yeah, I mean, it's even harder too when the business is performing, because you can make that. You can make that logical conclusion. If the business is deteriorating and you see insider selling, it's easier to make that jump. Like, okay, they're probably selling because of the business. But as investors and as capital allocators, it's hard for us to step inside their shoes as the operator and say, why would you sell? Because you're tied to this idea that the stock is worth X% more than it currently is right now. Mm-hmm. So that whole thinking and your whole idea of, why this person is selling is through that lens of, what are you doing? This thing can grow at 25, 30% for the next 5 years. Why aren't you buying? Why are you selling? And It gets back to what you said, like, well, maybe he's got something he's got to pay for. Like maybe he's got like a costly divorce and the wife takes half of the shares and he's got to sell it from his personal account. Like,
yes, you're right. Which I see in one of my stocks I own right now.
Oh, really? That's funny.
Yeah. So it's I don't know. Maybe if there's some kind of study to run between like selling and maybe some ratios on the balance sheet and income statement to kind of give us clues. I don't know if that would work, but
I mean, I wonder if there's a way to correlate between insider sells and some fundamental aspect of the business. So so basically you can say like, okay, when this person was selling, was the business improving? And then during that snapshot in time, then say, okay, then how did the business do after that? Right. Versus where when they were selling and let's say the business was deteriorating, maybe it's insider sales tied to gross margin or insider sales tied to EBIT margin or something like that. And then track that. I mean, that might be interesting.
Or maybe insider sales in relation to how long business has been doing well, right? Like how much of a growth cycle they've been in. Yeah, that'd be a really awesome study. We should definitely look into that one. Thank you for offering to do it. Just kidding. So go ahead. So keep going down that list there. Sorry.
Yeah. So the other one is asset play falls through, right. And it was Andrew and Geoff over at Focus Compound. They always talk about how like Andrew hates asset plays, some of the part stories, because a lot of the times the deal doesn't work. And so this is just kind of an ode to that, where if your whole thesis is based on the company selling something or liquidating something and then getting that cash and then returning that cash to shareholders, that's not necessarily that's a bad reason why the stock's being sold, because that means that it fell through and you're out of options. And if it goes back to this whole Occam's razor thing, where let's say you bought this stock and the one reason you bought it, let's say one of the two reasons is because you thought that this thing was being sold. Like, let's say it's a company that has one operating segment, but yet has like some sort of real estate. And its plan over time was to sell off that real estate and then return that back to shareholders in like this big cash dividend distribution. And let's say that falls through. Well, then that falling through completely destroys your bull thesis.
Right. And
so then you can understand why the stock's being sold. So that's why, that's why I really, really try not to look at asset plays. It's some of the part stories I'm getting better at not looking at, because it's just so hard. And it's just, you're once again, you're relying on these extraneous things that may or may not happen. And if you don't have any influence in the business, it doesn't matter if I write a blog post on MicroCap saying like, oh, check out this company. If they just divested, and if you do some of the parts, they're worth $16 a share. They're trading at $5 a share. It's like, no one really cares what I think. Like if I have a seat on the board, if I've got 5 to 7%, or, if I'm Connor Haley that shoots the lights out and never misses, then yeah, people might care. But those stories are hard, right? Because then you're betting on something that isn't the fundamentals of the business itself.
Yeah, those asset plays I found over time should be like putting on top. If they happen, they happen. But maybe they complement what's going on. So
right,
when that happens, all right. But it's not the crux of the story, right? And
because then you have to. Was I was going to say, because then you have to assign like a low probability expected value from that thing. So the expected value might be high, but you have to weight that appropriately to the odds of that actually happening.
Absolutely, yeah. One of my, I had a stock I was holding recently because I thought, it was basically stock was going through its growth cycle, and I thought getting maybe to a point where they couldn't grow some of the core as well, and so we thought it might be a good time to sell the company, and the company was all for that. It seemed, and all of a sudden overnight, well, we want to add another product to our portfolio. It's going to make it more grow, give it another growth spurt. Like here we go, and now I'm stuck, in this kind of purgatory. So I'm going through that with one of my holdings now. What do I do? Do I keep it now, and do I trust that they can grow, or now my thesis is a little bit different now, and it's kind of actually trading above where I thought the stock would get acquired. So what do I do? And now I'm getting greedy.
Well, yeah, it also goes back to the idea of portfolio management and then position sizing, right? Because if you size a position like that, let's say it's a low probability event that you need some sort of asset play to happen in order for you to get, that pop or that catalyst. If you weigh that in your portfolio, ideally, then you don't have to worry about it. If it fails, you're fine. If it goes well, hey, it's kind of like a call option where it's 1% of your portfolio. Boom, it pops. You make 4 or 5%, and then you move on. The danger happens when you get into misallocation of your position sizing, and now one of your larger bets is based on how management feels about some sort of asset sale.
Right. Yeah. Absolutely. I did end up selling 2/3 the position, so I have hopefully right sized it. So. Good. We're in trouble. All right, so you have something called the Hindenburg Report. Actually, he had a report today. I don't know if you saw it.
I did not. But every time he releases a report, actually, it's always the night before, right? Because they tease you. They're like, so tomorrow we're releasing a report on a company that we believe is a total fraud, and I'm just sitting there like, God, please not be one of my holdings. Like, God, please no. But yeah, no, I didn't see that they reported today. But it's also one of those things where if a company, like let's say Hindenburg or something like that, does a short report, that doesn't mean you're wrong, right? That doesn't mean that your analysis that you did was wrong. But what it does mean is that you really need to understand their side of the story, and you really need to see why they think it's a fraud. Because one of the things that I just totally admire about the short sellers is the amount of work that they put in to these reports. If you write a long report, not that you shouldn't, go in depth and have 20 to 30 pages of knowledge up inside your head. But when you're writing a short report, you have to really be an investigative journalist and present all the facts and present all the reasons why you're saying that this company is a short, because it's so against, the nature of the market. And, it's just so against how people normally think about stocks. People are naturally optimistic. They think stocks are going to go up over time. So I really respect the shorts and how they put out these detailed reports. So, definitely take note. For instance, Celsius, CELH, that's been one that's super popular right now. I used to own it. I don't own it anymore. I actually sold it a couple of weeks before the short report came out. And, you've got this battle between the longs and the shorts going on. And it's, the stock sold off, but it didn't really sell off super hard, like you would expect after a major short report. But it's just one of those things where if it comes out and it happens to be a name that you own, really take that to consideration, and have the humility to say, you know what, maybe they're right or maybe they're wrong. But at the same time, it's not a great reason for a stock to be selling, because somebody out there has devoted enough time, energy, and money to think that this thing is worth way less than what you probably think it's worth.
Right. Sure. But that's another tough one too, though, because the short game has become very diluted now. over the years, and everyone's, wants to be a short seller, an activist activist, and a lot of the alleged reports are low quality reports out there too. So a lot of times short, I guess it's a reverse value trap on the short selling side. Some of these short sellers will just take a risk factor or take something they haven't really understood or this guy's a criminal or whatever it might be. Mm-hmm. But the business itself, might still be good with somebody else managing the company, or it just might be fine. I mean, maybe they don't agree in the way the business is being run ethically, mm-hmm. But it may still be the right business. And
well, I just don't understand people's affinity for shorting, like direct to consumer fads or businesses that have, great leaders and great stories behind them. Right. For instance, like Celsius has killed it. I saw a tweet the other day that it was like the number 2 product on Amazon. And like, let's say you're right on the short. Let's say that this thing is actually, not as valuable as you thought. That still might not matter. I mean, we can just go back and look at Tesla. Like, sure, you can say that they're a fraud and you can say all this and all that, but at the end of the day, that story and that stock is tied to one person, and it's Elon Musk's vision of the future. And the same thing for Celsius, right? Like you can say like, okay, their European segment's super, it's overestimating what they're earning. It's actually a terrible business segment over there, et cetera, et cetera. But if they're flying off the shelves and if they're the number 2 seller on Amazon and if the company's growing like crazy, at a certain point, it's like, okay, you might be right on a factual basis, but that doesn't make you right in the market. And unfortunately,
and your timing too, your timing's gotta be right too.
Yeah. And so, that's why, again, people always think like, oh, I should look at shorts because they're hitting new highs. I just think you need to inverse that. Like, look for shorts that are hitting new lows and don't short these stocks that are hitting new highs, because you've got momentum behind them. And there's a reason that these stocks are hitting new highs. It might not be for the fundamentals, but at the same time, that doesn't matter given a time frame, especially in a short play, because you've got leverage involved, and the bigger the position, the worse it goes against you, the bigger the position. And so you're actually up against a wall. Mm-hmm. So, it's just, I just don't understand why people would short these names that are hitting new highs, that are just killing it direct to consumer, growing like crazy. Even if they're right, who knows? Like Celsius could explode from here, get acquired by Pepsi for 15 times sales.
Yeah, you just don't know what managers up their sleeves sometimes. There could be like, you could be wrong on timing, even if it does play out. There's so many things that could go wrong on that side. When we were shorting Geo, we were doing a lot of China shorts, they were 100% frauds. There was that was a lot different than the shorting these days, where there may be a company's 20% fraudulent, or you got creative accounting. It's really tough to dig into it and get investors to even care about it.
Yeah,
that's really, and because these regulators aren't caring about it, so why should market care about it? And that kind of was a subject of one of our podcasts that I think it was last week on Purple PRPL. When we first started looking at the company as a short, it was potentially, which we didn't end up doing. So that's good. $8 was $25, and we figured out, well, this is a short trap, because we tried talking ourselves into it for a while, and there was a lot of corporate governance issues. But what we really ended up asking ourselves was this: what happens when that's gone? What happens if they can reverse some of these things, right? And they really kind of are. Mm-hmm. And the corporate governance situation allowed the company, the founders of the company, to make a lot of money, we believe, at the expense of shareholders, but didn't invalidate the business. It just only invalidated how far the business could have went had they not done that. And now they've sold their stock, most of their stock. The founders, they're kind of unwinding some of the licensing arrangements that restricted their ability to compete or ability to earn revenue. Mm-hmm. And we're trying to understand that now. So, and it goes to what else he said, Purple's an incredible brand, right? It's one of those, you're shorting a brand that just, everyone, the millennials love it. The commercials are great. Robinhood loves it. And you say, so, and we said, what, we're not touching, we don't look at the bear and bull thesis, but not take any move on it. We should have bought it, obviously.
It's just such a tough game. Yeah. And it goes back to, fish in places where you think, you can have an edge over time. And to me, shorting those high growth, consumer driven brands that love, people that love those brands, shorting that is not the game that I want to play. Mainly because I don't think I'm smart enough to play that game. I think those guys over at Hindenburg and all those people that run those, short letters, they're ridiculously smart, but it's a game that I just don't want to play.
It's tough because, it's become a game of, 3 or 5% gains a day, covering your shorts. I mean, it's a pump and dump game reverse, but they're, the pump and dump are all game is on the long side. Most of them are, we'll agree, a lot of them are scams and, fraudulent companies. The shorts are actually right on a lot of their stories, but they have to cover because they can't be in these things when these things do rip. So it's a little, the reasons why they cover quickly is a little different, but you're playing for these 5-10%, drops in these stocks a lot of times.
Mm-hmm.
So it makes sense to me economically for the most part, but so let's get into and that was a great, anything else saying on value traps? I think that was the last thing on that list. Anything else you want to add before we go into your little stock pitch here?
Yeah. I mean, I just want to say in terms of value traps, I just don't know if I like the idea of naming it value traps. The more I think about it, I just think that there's good businesses and bad businesses,
right.
And a value trap isn't necessarily you buying a crappy business. A value trap is just you being wrong, and so whether that's on the business analysis side or paying too much. And so when I think of how to avoid value traps, I think of it in terms of, okay, is this a good business? Are the fundamental unit economics of this business good? And a lot of this I got from Connor Haley over at Alta Fox. He just really, really reiterates and I spent a lot of time reading his letters, and it's just focusing on the individual unit economics. And so if you can understand those and you can say, okay, this is a good business, then that right there reduces your odds of making a bad decision. Obviously, you're going to make a lot of bad decisions, but if you're looking in those areas, you're already in a better spot than most people. And then
you can overpay and still be right.
Exactly. And so, And so then the second thing is like, okay, what am I paying for this business? Because you can be right on the unit economics and then be wrong on the price you pay, which is, I saw Value Stock Geek actually just tweeted this morning. I think it was Home Depot between, it was like a 10-year span, but basically they grew earnings at a pretty decent clip. Like they compounded earnings over 10 years at a great clip, but the stock returned 1.2%. And that was because during that same time, the PE went from 43 to 18.
Mm-hmm.
And so, it's this two-factored thing where it's like, okay, is this business a good business? Check. Yes. Okay. My odds of finding a value trap, in air quotes, are reduced by X. And then second, am I paying a decent price for this business, or am I getting this, business for super cheap? Right. And if the answer is yes to that one, then it's like, okay, then your odds of this being a value trap, in quotes, are very slim. That doesn't mean that things can't happen and then, the business turns against you and goes bad. But at the end of the day, that's how you should think about value traps. Is it's not necessarily like, oh, I got trapped. Like GameStop, people think is a classic value trap. I mean, it is, but it also isn't, right? Like there's a reason Burry bought it, and it was, super cheap according to, the ways you looked at it. It was, on its lows, but it was riding, it had some positive momentum. And so you just have to think about it that way. It's not value traps. It's whether you're right or wrong. And you base that on the quality of the business and the price you pay for that business.
I think a really important lesson from that, Brandon, is that, if you're a new investor or getting into this business really quickly, or young, and trying to, figure things out, you're reading the books, you're reading about value investing. I want to, get these cheap stocks. If you buy these stocks just based on what you're looking at on the fundamentals, the low PEs, the low, price to book multiples, these things, that's where the trap could be, right? We haven't done your homework.
Mm-hmm.
So there's this belief that all undervalued stocks, like, there might be, with these low valuations, are great buys, right? And that's not the
Mm-hmm.
case. You always have to look at the business, especially the quality of the business, to understand, how can this going to look, 5-10 years from now, going to be a lot bigger. But yeah, you're right, man. So,
well, that's kind of thing is like the more I've studied this game and this craft, and the more I've learned from other people, the more I realize that these PE ratios, they don't matter. Like, in the sense of everything that you're paying for is going to happen in the future, and all these things are backward looking. Yeah. And so it does you no good to anchor yourself to a PE or to an EV to EBIT if you don't understand the fundamentals of the business and where you think it could be in 5 years. Because you can, like like we're about to go in with one of the businesses that I'm invested in. Like if a company's losing money or if the company's on the precipice of making money, like those metrics they don't matter. You're trading at 500 times earnings because the company just turned profitable. So like if I could go back in time when I started investing, I would wish that I spent more time understanding a business and not really caring what the multiple is. And what investors are paying for now. What I want to care about is this a good business? And do I think this business is going to be a bigger business and generating more cash flow over the next 5 years? Like if I just focused on that, I would have avoided Target Hospitality, because if you have that time frame, then you're thinking about the durability of a business. You're thinking about its ability to generate cash flow over the next 5, 10, 15 years. And you start thinking about terminal values, and you start thinking about, okay, is this business actually valuable to its customers? Do its customers love the business? You're not focusing on PEs or EV to EBITDA. You're focusing on what you're buying and becoming a part owner in that business and in its economics.
Absolutely. And it forces you away from thinking short term, which is really the important point you're really stressing there. I think if you look at address the questions that you're talking about, how much bigger can the company be in 5-10 years, along with liquidity questions, you kind of really, can they do it without raising too much capital, or, how did the balance sheet look? If you have a balance sheet that can last 5-10 years and be a lot, and they can be a lot bigger in 5-10 years, the valuation, in the next 12 months, you might not really care, but if it's reasonable enough, right?
Mm-hmm.
Of course, valuation and price matters to some degree, but for these turnarounds, like you said, I mean, then what do you have to look out things outside that? And so that's the qualitative, and that's where you get a lot of your 10, 15, 20 baggers is from these companies that aren't making money right now, that look expensive right now, that look really cheap 5 years from now at that price. So.
Yeah, and Burry used to talk about in his letters. Burry's actually, I'm the biggest Michael Burry fanboy. He's my favorite investor of all time, and in his letters, or I don't know if it was his letters or if it was his MSN Money forum articles, but he had a stat, and I don't know if I'm going to get this completely correct, but basically he said 70% of the value of a business is in its ability to generate cash flows 7 to 10 years from today. And like when you just stop and think about that, it's like, oh my gosh, like that's a huge revelation. What matters isn't what the company generates this year or even what the company generates next year. Like what matters is what the company generates 6, 7, 8 years from now. And I'm not saying anything new, right? Like that's that's kind of one of the reasons why I was always hesitant to come on a podcast. It's like, what do I have to say that other people way smarter than me haven't said before? But I think if I can help one person realize that, that's what matters. It doesn't matter if a company's trading at 5 times EBITDA now, because that company can trade down to 3 or 2 times EBITDA. What matters is the cash that business can generate in years 7, 8, 9.
No, I think it's important to keep on saying, Brandon, because I mean, we can say it and hear it, but it might not click, until in someone's head until a certain period of time. So I think it's really important to keep bringing that out. And to me, it's probably one of the most important points you made today, and it helps us focus on the understanding of business more. When we do that kind of analysis, we know which we're investing in a lot more than looking at a short-term valuation stat or something. It really forces us to think more critically.
And I wish I could say that it was just like super easy for me to apply this to and just say, oh, that's, all that matters is what happens in 5, 6 years. But I'd be lying if I said that if I saw a stock that I own go down pretty hard, I wish I could tell you that I'm like Buffett. I have no screens. I just read 10Ks. I print them out. I go all Andrew Kuhn on everybody and print everything out. I wish I could tell you that was the case, but it's not. And the reason why I reiterated that is because it's, really it's for myself. When I go back and listen to this, it's like, okay, Brandon, this is really what matters. And for those, I'll just give one more little quick shout out to Cliff Sosin, who is probably the one investor that's influenced my philosophy the most. I did a podcast with him, and he's in a podcast with Andrew over at Yet Another Value podcast. He's the best investor that I know on focusing on what matters, and that's the 5 to 10 year time frame. So I kind of owe all of what I'm trying to do. I owe it to listening to him and trying to learn from him.
We'll make sure everybody you mentioned today we'll get a
Yeah, which is actually going to be a lot now that I think about it.
Yeah, maybe a nice little tweet.
Bobby's shaking his head like, dude, these show notes are going to be nuts.
Have fun, Bobby. All right, so you are the producer. You said it. So, Brandon, why don't you get into why you like a stock in 90 seconds?
Show notes. I got to do show notes on this one.
Come on, Bobby. All right, so let me share my screen here because I know you wanted me to get a little slide deck on the company here.
Right.
Host disabled attendee screen sharing. Bobby, you want to open that up for me real quick?
Let's go, Bobby.
If not, we can always just roll through it, but let me see.
Give me 2 seconds here, everybody.
Yeah, that's fine.
Multiple participants can share simultaneously. Do your thing, sir.
All right, cool. Let me share. Okay, awesome.
At some point, are we going to do the segment I hope to do today, which was, finding value traps in the upcoming slate of football games?
Yeah, we can do that.
Well, I got a little bit left time on my computer before it dies. We'll see, Robert.
Okay, all right. So I'll kind of make this quick here. So the stock that I wanted to do in 90 seconds or less is Ammo Inc. The ticker is POW, and they are the hottest bullet on the market. What they do is they make non-incendiary ammunition for law enforcement, retail, and military and defense. And they're really one of the only kinds of bullets that they produce. They have a patent protection on this technology where when you shoot it, the shooter and the people behind you can see the tracer, and it's like this it's this red dart. So for Star Wars fans out there, think of those Star Wars blasters. That's literally what it looks like. You can look it up. It's super cool, and it's non-incendiary, so it doesn't produce heat. So retail, just regular gun owners that want to go to gun ranges, they can take this stuff there, shoot it, and see the tracers themselves. It's a really unique business. It's growing top line revenue 140% over the last 3 years. It's slated to hit $50 million in revenue for the end of this year, which is going to be a 240% increase year over year. And they're projecting profitable EBITDA by this coming quarter here. So their accounting is like 1 year forward. So they're in forward year 2021 right now. Given their technology, they command a premium product in the ammunition market. So the ammunition market's normally dominated by 15 to 20% gross margin products. They can actually charge a 30% margin and get away with it because the technology is so new and there's nothing like it. And they have super fans. So if you look on their reviews and stuff, people love this product. They can't buy more of it. They love it. And it trades less than 2.5 times its current sales, or its projected, year-end sales. If it hits 50 million, it's going to be trading less than 2.5 times. And the founder, Fred Wagenhals, owns 16% of the business. He's actually a pretty cool dude. He ran a business. He actually took a company public. It was a die cast model for NASCAR, like memorabilia and stuff. And he sold that business. He grew, he 10x sales, and then he sold it off, and then he won the lottery in Arizona. and now he's running this business, and the company's cranking out product. They're working 7 days a week, 24/7 around the clock to fulfill their orders. They have a market cap of about 120 million, give or take, and their order backlog as of a few weeks ago was $80 million. So I think at the end of the day, this company could get acquired from a bigger player like a Sturm Ruger or a Smith & Wesson, and at 2.5 times sales, growing over 140% over the last 3 years. We're really excited about it. It's my largest position.
Awesome, Brandon. And are they well capitalized? Did they have to raise money, or are they going to?
Yep. So they're probably going to have to do one more equity raise, I believe. They have so many orders, and they bought more equipment. So, they just purchased a bunch of equipment to get everything, to be able to actually fulfill these orders. So I'm expecting either an equity raise, or, some sort of debt issuance, but it should just be like one more equity raise. And then, before they actually reach their, operating scale and can start growing here. Share dilution is definitely an issue here. So anything more than one additional equity raise, I would be a little bit suspect.
Okay, great. And have they kind of communicated that to the public that maybe one more and that's it, or is that your guess? Right?
No, that's just kind of what I'm guessing based on their current run rate production and then the cash that they've got in the bank as of last quarter. So we'll definitely get more insight when they report next. I'm actually trying to get Wagenhals on my podcast for my MacroOps collective members, so I can ask him just kind of some questions about that as well. But that's what I'm expecting. If we get more equity raises, I would not be as excited about that.
Excellent. All right. Well, thanks, Brandon. It was awesome having you here. I mean, we're going to learn a lot from this podcast, going back and looking at it and reading it. And you did a great job. They're not better than I did in yours for sure, 100%.
Well, no, I don't think that. I hope people can piece together some semblance of insight. But like I said, nothing that I said here is revolutionary or unique to me. But it's things that I have to keep reiterating to myself because I know that I can fall victim to some of these traps, like some of these value traps, trying to find these good businesses. So, if one or two things I said resonated with somebody, then I guess I did my job here.
Well, the more I hear it, from people like you and, other great investors, is the more I begin to believe it too. So it took me many, many years to get outside the way I used to think and start thinking the way some of these things you're talking about here. So I appreciate it. And I'm sure a lot of our listeners will appreciate it. And we can't assume everyone's heard this stuff before.
That's a good point. Something I'm working on.
Okay, man. All right, Bobby, we're done. This is like getting really hot.
Hold on. Yeah. Are we done showing off yet? Okay. I mean, this is, I don't know. This might be the most shout outs I'm going to have to do in any episode ever to this point, but that's a good thing. Yeah. I mean, that if there's any indication there to everybody listening, I mean, Brandon does a great job over at the Value High podcast. And if there's any indication that he actually listens to what the people are saying, I think you heard it today. All right. So,
I mean, look,
actually took some lessons from that.
Yeah. I try to give credit to where credit's due because there's so many sharp people 100%. Out there. And it's extremely, it's extremely humbling to think that there are people out there that put me in that same bucket because I still think I have so much to learn. And there's just so much that I don't know. So it's extremely humbling to come on this podcast. And, I appreciate you guys giving me the chance.
Thanks, yeah, absolutely. All right. Well, real quick, before I let anybody go, we're going to do there's a new segment.
Okay.
Finding value traps in the upcoming football slate. Okay. I'm going through the schedule right now. All right. We got Maj's team is playing. Who is Pittsburgh playing? Oh, they're playing Cleveland. See, for me, I think Cleveland is probably the biggest value trap of if you were to bet on Cleveland to win this game. That is for sure a value trap. They are at, or are they not? I mean, are they trading at an all-time high right now? They're 4-1.
Yeah. Because here's the thing, Bobby. It's like almost like are you shorting the Browns at its 52-week high? Like you have to ask yourself that.
Yeah. Are we? I know Maj is.
I'm ready. Well, the Browns, they're never going to lose again. Steelers. Well, the Browns came off a really big win, this weekend.
Right.
It was an upset, and a lot
of times. Was it an upset?
Colts.
Philip Rivers. He's got a little. This is his arm. His little noodle arm right here.
Yeah, maybe, maybe not. But I thought they'd win that game. Lose that game, but they're looking pretty good actually. Cleveland. People forget
they
that
have a coach.
They've had a pretty good 2-year run. So, but look, I think they're coming off a little bit of a high there. And Steelers actually didn't play too good against the Eagles. They got away with winning that game. But they found a new receiver in that mix who's really been doing who really broke out that game. So I think that you're going to see a Steelers game coming off. Hey, we luckily won this game. Then we better get our Cleveland looks pretty good. I think they'll be ready for the game and they're going to win the game pretty easily.
Bobby, do you know the spread on that game so far?
I do not. I'm an idiot. I told this to Maj like a couple weeks ago that I don't understand spreads very well. So this is just more of like a pick'em situation. Well, all right, hold on. Maj will get the spreads. But while Maj is getting the spreads, all right. So actually, Brandon and I, both our favorite teams are facing off against each other, the Washington football team and then the Giants. I feel like this is a matchup between two OTC pink listed companies that are burning cash at an exponential rate without a real product, but maybe are in the Bitcoin space. Right? I think no, actually, that would be that. Then they might have a little hype to them, and there's literally no hype on them at all, except maybe Washington with their defense. But so maybe in a dying industry. How about that?
Well, I mean, the thing is, if we're thinking about it this way, you've got a good co, bad co situation with the Washington football team. You've got a good co in their defense. So if they could find a way to spin off that defense, and I could only watch their defense play, specifically their front four or their front seven. I think you stick a 15x multiple on their front seven, and that's an attractive business. But yet then you've got the bad co, which is the quarterback carousel in a declining industry with shrinking margins, and they keep having to do equity raises because they have one quarterback after another. And the other problem is they have all of these liabilities on the balance sheet because they have to keep paying these quarterbacks that they draft that they don't use. And so you have assets that are now liabilities on the balance sheet that are draining cash, and you're not scoring points. So you're not bringing in any revenue. It's, so if they can divest that and only play a defense, and I don't have to watch their offense, I mean, 15x on their defense over the next 3 to 5 years, I think you get a pretty decent return.
Okay, Brandon, you just earned yourself an invite back literally every week just to do that. Okay, Brandon, I did not let Brandon know that we were going to do this segment, and just that was one of the best analogies. That was one of the best analogies I think I've heard.
Well, here's kind of the funny thing too, though. Like, take everything I say about football and do the opposite, because I am in a fantasy football league, and just for everybody to understand my like breadth of knowledge. Well, no, listen to this. I had Chris Carson on my roster, really good apparently, from the Seahawks, and he was injured. I didn't do my due diligence. I didn't see that this was going to be just a short-term earnings miss, a 1-week earnings miss. And so what did I do? I sold.
Oh.
I was a forced seller. Didn't even trade him, right? Didn't even do some sort of asset sale. Just sold him. Put him up for free agency. Someone picked him up, and he's gone off ever since. And so everything that I say about fantasy football or about football in general, just do the opposite. I'm the Scott Galloway of fantasy football. So just do the opposite and you'll be fine.
Bro, that is a brutal drop. Oh my gosh.
Yeah, dude. You don't have to tell me.
Oh man, I thought you were gonna at least say you traded him. Like, all right, you get some value, like whatever.
No, that's no. Trading him is way too successful.
What round did you get him in?
Let's see. You're probably gonna love this one. I think I auto picked him. I did the first few picks, and I said, "Screw it, this is boring," and I just closed my laptop.
Oh, that's too funny.
I haven't played fantasy in 4 years. It was just too much work. I just got too obsessed with it. I didn't want to lose, and then you just get all these research till 3 o'clock in the morning.
Yeah, Maj, you're not missing much. I mean, I'm in it just for the goodwill of one of my best friends. So
I like it. I mean, it's just a matter of like I was making more money looking at my stocks than I was in my football team, where I was losing money every year.
You guys are gonna be jealous. I won my fantasy basketball league for the first time in I think 10 years.
Well, I mean, Bobby, that makes sense though, right? Because that's like looking in Poland microcaps. Like, no one does fantasy basketball. So,
dude, I'll tell you, I used to be like, the only sport I ever did was fantasy baseball, and that literally took up all my time. Because because we had unlimited ad drops too, so you're just picking up pitchers. So if you get a pitcher that's pitched twice a week, you're always getting.
Well, and you got 162 games too, so
yeah, so it's a mess. But yeah, and then I was doing football, but I needed to keep my fix in a little bit, so I just started doing basketball. But it's fun. But listen,
I actually had built a fantasy football software game. I was doing it for 2 years, in development, and I was ready to launch it right when the whole FanDuel DraftKings things blew up.
Wow!
Oh, no way!
Why didn't you do a SPAC, Maj? Gosh, you could have been.
That was great. I got to bring it back.
Maj wouldn't even be on this podcast right now if he did that.
Yo, speaking of SPACs, if you guys want, you guys should come on Thursday. We're doing for the Investors Roundtable. We're doing a "What the hell is going on with SPACs" episode.
I don't know enough about SPACs.
Yeah, I don't know if I'm the right guy for that, considering my last SPAC pick went minus 80%. So,
guess what? You're perfect. No, I'm just kidding. All right, guys, let's land the plane. Where can everybody go and follow you on social media and your website and whatnot?
Yeah, Maj, you want to take this first?
Oh yeah, so I'm the co-founder of Geo Investing. You can go to geoinvesting.com, find out about our free trial there. We also have a monthly trial. Follow me on Twitter at Maj Geo Investing. You can follow the company at Geo Investing, also on Twitter, and you can send me an email at maj@geoinvesting.com. You have any questions for us or any podcast ideas you're actually looking for us to do?
There you go.
Brandon?
All right. Yeah. So you can find me on Twitter at MarketPlunger1. You can also find me online at macro-ops.com. We run, we're a global macro research shop that dedicates, all of our time to finding these really awesome thematic ideas and companies that we think can generate asymmetric returns over the next 3 to 5 years. And we also, since I'm a guest on a podcast, I guess I can kind of pitch our premium product here. This is, kind of a first time here, but we've got the Macro Ops Collective, which is a collection of, the world's best traders and investors and people that are just really hungry to learn and get better. And we have premium research for them. I'm working on getting a collective only podcast where we interview founders and CEOs of these public companies of our own portfolio holdings. And so you can go to macro-ops.com/collective to learn more about that. It's an amazing service. And, we release it, I think, probably once a month, but space is limited. So if you're interested, you can shoot me an email, Brandon at macro-ops.com.
Yeah, let's talk more about that too offline, Brian. I'd learn more about that product and see maybe introduce some of Geo Investing members to that.
Yeah, let's do it.
All right, dudes. Well, again, I'm your producer on this show, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft, BOBBYKKRAFT. You can listen to Avoiding the Crowd on Podbean at avoidingthecrowd.podbean.com. You can also watch this on YouTube at youtube.com/SNNWire. I know Brandon is always impressed by this, so that's why I'm kind of showing off a little bit with running this off. But look, with that, thank you guys. Brandon, always welcome back on any of the shows. We gotta get you on Planet MicroCap too at some point.
Oh man, that'd be cheese. I'm about to be on the podcast carousel. I don't know if I'm ready for that, Bobby.
Let's go, dude. Oh, come on, man. Let's go.
Don't say yes. He's gonna ask you every other week to come on.
Don't tempt me. Don't tempt me. All right, guys. Have a good one. All right.
Awesome. See you guys.
See you guys. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network and Maj Soueidan are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy, sell, short, cover securities in any company mentioned and may profit in the event those securities rise in value if we are long and fall if we are short. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.